Hello everyone, I'm Steve, and today we're diving deep into a fundamental concept for any derivative trader: understanding the difference between futures margin and options margin. If you're trading futures or options, understanding margin isn't just helpful, it's absolutely essential for proper risk management. This video will clear up common misconceptions. Welcome to the trading desk. Margin in derivatives is often misunderstood, even by seasoned investors. Let's set the record straight and provide clarity. Our focus today is comparing futures margin, often called a quote performance bond, with options margin, which acts more like collateral against risk, especially for short positions. At its core, margin is the capital required to enter and maintain a leveraged position. It's a security deposit to cover potential losses, not necessarily a loan. In stock trading, margin is usually a loan from your broker to buy more shares. In futures and options, however, it serves a different function entirely. The core difference lies here. Futures margin is not a loan. It's properly termed a performance bond, required by the exchange clearinghouse to ensure you meet your contractual obligations. This bond is simply a fractional amount of the total contract value. It's a small sum of money put up to guarantee performance on a contract that controls a much larger asset value. A performance bond guarantees that both parties in a futures contract will fulfill their end of the agreement. This mechanism is key to minimizing counterparty risk within the futures market. Futures margin has two levels: initial margin, required to open a position, and maintenance margin, the minimum capital needed to keep the position open. If your account drops below maintenance, you face a margin call. Please, dispel the common misconception. Futures margin is not a loan, and it is not a down payment on the asset. It's risk collateral, plain and simple. Options margin is different. For long option positions, no margin is typically required beyond the premium paid. However, for short option positions, margin becomes necessary. If you sell a naked or uncovered option, meaning you don't own the underlying asset or a protective option, margin is required as collateral against the potentially unlimited risk of that short position. The amount of margin required for a short option position is calculated based on the maximum potential loss, though this calculation can be quite complex and broker-dependent. Let's bring this to life with a practical example that many futures traders encounter daily, comparing the margin requirements for the E-mini S&P 500 contract and its micro counterpart. The E-mini S&P 500, or /ES, is the standard. The micro E-mini, or /MES, is just 1/10 the size, making it far more accessible for newer or smaller accounts. For example, the initial margin for one /ES contract might be around $12,000, while the /MES requires just $1,200. This highlights the scaled risk exposure. The difference in margin requirement reflects the massive difference in leverage and, therefore, the risk profile of each contract. Micro contracts allow for better position sizing and risk management for smaller accounts. Before we wrap up, I want to offer some final thoughts from a veteran's perspective. Understanding margin is about understanding leverage. To summarize, futures margin is a quote performance bond guaranteeing trade completion, while options margin is primarily collateral required for short positions to cover potential maximum loss. Always respect the leverage these products offer. Use proper risk capital. Never trade more than you can afford to lose, and use margin responsibly.